Today, I'm going to explain how asset allocations are failing retirement investors. Every year, I spend hours helping my clients interpret their portfolio performance so that they can reduce volatility and get the most out of their retirement savings. Despite the fact that asset allocations have become the gold standard of retirement portfolio construction, there are actually some major pitfalls to be aware of when using them. And these pitfalls often lead to retirees having more risk in their portfolios than they are led to believe, which leads to feelings of anxiety and helplessness when transitioning to retirement and needing to convert your assets into income that you can live off of. So let's jump right into a scenario that will frame the asset allocation problem. I'm going to share a couple slides on the screen here that illustrate what I'm about to talk about. So during the 2022 market downturn, from January 2022 through October 2022, the S&P 500 was down 24% from peak to trough, and that's what you're seeing on the screen here. Now, over roughly that same time period, what I'm switching to now, VBTLX, which is the Vanguard Total Bond Market Fund, which owns a blend of US Treasury bonds, corporate bonds, high-yield bonds, and some mortgage-backed securities, was down 15.5%, and that's what you see on the screen here. Switching slides once further, TLT, which is the iShares 20-year US Treasury Bond Fund, was down 32% over that same time period. And so if you were invested in a 60-40 stock portfolio, which is now what I'm showing on the screen, over that same time period, you would have lost roughly 21% of your total portfolio value, and stocks had performed badly during that time. Bonds, in many cases, performed worse, and investors were just kind of blindsided. Your 60-40 portfolio would not have recovered from its losses until May 2024. It would have taken a 29-month journey to nowhere. And over that time period, that portfolio would have lost purchasing power as it not only declined in value and then gradually recovered, but as inflation caused prices to go up over that same time period. And to add insult to injury, the S&P 500 recovered fully by December 2023 and would have grown by 11.6% over that same time period ending in May of 2024. So how do we make sense of this given that asset allocations were pitched to us as tools that would inform investment decisions and help investors manage risk? I believe there are four key problems with asset allocations that led to poor investor outcomes like what I just described. The first problem is that asset allocations obfuscate or hide important information that lies beneath the surface, especially when it comes to understanding the risks your portfolio might face. For instance, what about bond funds like VBTLX, the Vanguard Total Bond Market Fund, or AGG, the iShares version or equivalent of that fund, both of which hold corporate bonds, junk bonds, and mortgage-backed securities? In fact, I'm going to pull this up on the screen right here, but VBTLX, the Total Vanguard Bond Market Fund, holds nearly 26% of A-rated or BBB-rated investments, which are the third and fourth tier of credit quality. And 13.2% of VBTLX holdings are actually BBB-rated, which is the fourth tier of credit quality. For AGG, the comparable exchange-traded fund rather than a mutual fund, 56% of its holdings are mortgage-backed securities, corporate bonds, or commercial mortgage-backed securities. You can see that on the screen here. Now, those investments might all be considered risky. So why are they included on the safety side or the bond side of your asset allocation equation? What about dividend or value stocks, companies like Pepsi or Kroger, which during the 2022 market correction didn't lose any value at all, but in fact went up in value, and that's what you're seeing on the screen here. Over the course of the 2022 market correction, Pepsi was up about 6%, Kroger was up about 6%, and they're bundled into the same risk category as Meta, which over that same time period went down 73% roughly. Or finally, what about the fact that VOO, which I'm now showing the top 10 holdings of on the screen, has 35% of its funds invested into the top 10 holdings, while the remaining 490 companies receive 65% of the remaining funds? To be clear, I'm not saying that any of what I've just described or any of the things I've shown about how these funds are constructed is inherently wrong or dishonest. I'm just trying to illustrate that surface level metrics like asset allocation don't tell us anything about what's going on beneath the surface, just like what I've shown on the screen so far. The second problem with asset allocations is that they lead to impulsive decision-making. So take a scenario with the correction in 2022 as an example. You watch not just the stock, but also the bond part of your portfolio go down month by month. And you'd say to yourself, but I'm in a 60-40 asset allocation. My portfolio should be hedged against this market correction. And eventually, as you continue to watch your portfolio value go down, and now only with hindsight did we know that the decline would be limited to 21%, but at the time you don't know that. And so you change your investment mix and reduce some risk by selling part of your stock allocation, which is the risky part of your portfolio. In hindsight, would have been a huge mistake because not only did stocks recover faster than bonds as a whole, but generally speaking, bonds, especially many types of the safe US government bonds, have actually performed far worse than stocks as a whole over that same time period. Now, the third problem with asset allocation is hesitance. So carrying that prior scenario forward, in 2022, you change your investment mix and reduce equity exposure. You reduce the risky side of your allocation. And the problem now is that you don't really trust the conventional wisdom any longer because it didn't work as advertised. And now you don't really know when to re-enter the stock market. Again, you don't know when the bottom of the market will come in, and so you miss the bottom of the correction. And then you're late getting back into the stock market because you're hesitant, and understandably so. So what happens at the end is that you lose value on the front end during the correction, and then you lag getting back into the market after reducing risk in your portfolio, and you lose value on the back end. And even in a scenario where you held on to your 60-40 portfolio and did nothing, you still took that 2.5-year journey to nowhere only to lose purchasing power due to inflation. Which leads to the fourth problem with asset allocations. They cause what I call the confidence loss snowball effect. As a result of everything that transpired up to this point, you begin to lose confidence. That loss of confidence snowballs, and eventually we either make impulsive decisions or we become paralyzed out of fear and stop making decisions, rather than having a plan that allows us to calmly make decisions based on education. And I believe all this is a result of the fact that asset allocations are advertised as a tool that should tell an investor how to split their funds between two categories of investments, risk and safety. The conventional wisdom is that risk assets are stocks, also known as equities. And safe assets are things like bonds, also known as fixed income. And that conventional wisdom goes on to say that while you are young, you should have more aggressive asset allocations, perhaps 80% in risk or stock assets and 20% in safe assets or bonds. And that as you near retirement, you should slowly decrease how much of your funds are allocated toward risk assets and increase how much are allocated towards safe assets as a way to manage investment risk and volatility. That way, if there is a stock market correction when you are near or in the early part of your retirement, you won't feel the shock of it quite as abruptly because you reduced your investment risk as you age. Those results have not materialized, and that's largely because for the last 20 years, we have been living in a previously unforeseen interest rate environment. That interest rate environment has had a profound effect on the utility of asset allocations. Specifically, certain type of investments are more or less sensitive to interest rates. And this means that the price of a certain investment is more likely to go down or go up in larger proportion due to changes in the interest rate environment. Long duration US government bonds are a great example. I'll pull one up on the screen here. Remember that fund TLT that I mentioned earlier? That's the 20-plus year US government bond fund. And since the start of 2022, that fund, which is considered a safe asset, remember it would go into the bond or safe part of your asset allocation, was down nearly 41% at its lowest point, and that's what you see on the screen here. Nearly double the maximum loss experienced by VOO, which is the common Vanguard S&P 500 index fund. And this is because bonds with longer duration, meaning longer contractual lifespans, those values go down when interest rates go up, and their values go up when interest rates go down. So when interest rates are artificially low, as they were from 2008 through 2022, an investor can know with a high degree of certainty that there is very little upside, in fact, mostly only downside, to owning a longer duration bond, because the price of that bond cannot go up much further, but in fact can only go down when interest rates are held at their lowest point. And the opposite is true as well. When interest rates are high, as they are now, an investor can know with a high degree of certainty that those longer bonds will likely have an increase in value when interest rates drop. As a result, I believe a more robust and comprehensive approach needs to be taken with regards to risk management of a retirement portfolio. So how do we solve the asset allocation here at Peak Financial Planning? Well, the first step is to start with some education. First, why do we buy risk assets? We buy risk assets for the opportunity of capital appreciation. Essentially, we want to buy an investment at a low price, hold it for a period of time, and then benefit from the price fluctuation by selling it at a higher price in the future. Along the way, we benefit tax-wise by not paying taxes on unrealized gains, and at the end of the day, in this way, we can maintain purchasing power and mitigate the effects of inflation and hopefully grow our wealth along the way. So now why do we buy conservative assets? We buy conservative or safe assets as a hedge against our risk assets. That hedge functions by having lower price volatility, meaning the price fluctuates a lot less or maybe not at all in some cases. We may also receive some form of compensation in the form of interest or guaranteed income. And the conservative asset usually also comes with some kind of guaranteed return of principal. For example, when you invest in a certificate of deposit, a bond, or even a bank account, you are guaranteed to receive your original investment money back at the end of the specified investment period. But in exchange for the security or stability of the investment, you give up investment upside and accept lower returns for that category of investments. But the asset allocation problem is even further exacerbated when we use index funds or mutual funds to purchase bonds as a part of our safe allocation. And that's because when you own bonds via a fund, you give up the guaranteed return of capital protection that you get when you own the bond directly. And that is a key reason to own a bond. Actually, it's the primary reason as investors that we accept the lower rate of return, because we know that in exchange for that lower rate of return, we have a guarantee that at the end of the investment period, we will get our original investment money back. So I'll illustrate this really briefly. I'm going to show a chart on the screen here. There's two different funds that are shown on this screen. One is called VBTLX, which I alluded to earlier, and the other is called TLT. VBTLX is the total bond market fund. It's a Vanguard bond market fund, and TLT is the 20-year US Treasury fund. Now, in this scenario on the screen, if you had bought $1 million of each fund, which is what this shows, at the beginning of 2023, and you held on to it until today, which is August of 2024, I'm losing track of time here, August of 2024, you would have had a meager 6.61% annual growth rate, a 61 basis point growth rate on your total bond fund, VBTLX, and that's what the blue line on the screen shows. And you would have had a slightly less depressing 1.18% return on your TLT or long US government bond fund, and that's the green line here. And that's, remember, if you did a buy and hold, you bought it 2003, you held it to 2024. But what if you had bought into TLT or VBTLX anytime over here in the middle in 2014 or 2016, and you held it from there until 2021? Well, that safe part of your portfolio actually ends up quite risky, and you can see here all dot on the screen. What if you bought the bond fund somewhere over here or somewhere over here? You would have held it until here, and that bond fund would have just simply decreased in value. And that safe part of your portfolio ends up being quite risky. You would have bought those funds, both of them, either the 20-year or the total bond market fund, when they were at their most expensive, while also getting them while their interest yields were lowest to you as an investor. The worst of both worlds. And now you would be sitting on losses in those bond funds here in 2024 because interest rates are higher than when those bond funds were initially purchased. So how do we address the asset allocation now, understanding all of this here at Peak Financial Planning? The first method is to use additional measures of risk beyond asset allocation. So we favor 4 risk measures. The first is called beta. Beta tells you if the stock market goes up 1% and you have a beta of 1%, it tells you how much your portfolio will move in line with the market. So a beta of 1 means you will move exactly dollar for dollar with the broader stock market. A beta of -1 means your portfolio will move exactly inversely. So if the market goes up 1%, your portfolio would go down 1%. And a beta of 0.5 means your portfolio would capture half the upside of the market, but also only capture half the downside of the market. It's a useful historic metric. The second metric we care about is market correlation. Market correlation, instead of telling you how much your portfolio will go up or down in line with the market, it tells you historically how often has your portfolio traveled in the same direction as the market. It's a metric that helps us understand diversification. How likely are you to travel in the same direction as the market? The third metric we care about is standard deviation. Standard deviation is a statistic or probabilistic measure that tells you the likelihood of your portfolio going down by a certain amount. The higher the standard deviation, the more volatile your portfolio is. And then we use a fourth metric called max drawdown, and that allows you to evaluate historic scenarios and find out how much would the biggest drop in your portfolio's value have been over historic market performance or market periods. The second way we address the asset allocation problem is we reduce portfolio volatility using a more specific investment allocation approach. We invest in directly held bonds when appropriate in order to obtain that guaranteed return of capital. And when we do use bond funds in clients' portfolios, we have buy and sell targets, buying when interest rates are high and selling when interest rates are low, rather than sitting on them long-term in all scenarios. We also invest in directly held stocks because this gives us more at-bats or more opportunities to play portfolio defense. When you invest in stocks through a fund and certain sectors of the economy or certain companies themselves go through a period of price declines, You cannot sell a part of your fund in order to reorganize your portfolio and limit the damage. The only option you have is to simply buy and hold that fund and wait for it to recover as a whole, meaning you give up having any influence over your portfolio's outcome. Owning single stocks outright allows you to trim underperforming parts of your portfolio, still achieving protection via diversification, so long as you combine single stock ownership with monitoring risk measures like the ones we just outlined a moment ago. As a part of these investment approaches, we also shift our focus from maximizing rate of return as the primary orientation to a focus on downside protection. The third way that we address the asset allocation problem is that we regularly backtest portfolios and reference historical data to understand how a proposed investment portfolio may have performed in the past. While past performance does not predict future outcomes, using historical information to model scenarios before they happen allows us to quiz ourselves. For instance, how would we respond if X happens and the portfolio goes down by Y amount? So why do I believe that asset allocations have taken such a foothold? I believe that the usage of asset allocations reduces decision-making friction by taking a high consequence, high-risk subject and making it seem simple. Investing is actually a complex discipline, and if you as a consumer are constantly told that it's complex, it's likely that we as consumers would be paralyzed and probably make slower decisions. And those slower decisions would actually likely be better for you and I as consumers, but worse for Wall Street and big finance. Not only that, asset allocations allow underqualified investment advisors to appear to do a job that they are in fact underqualified to do. They may have no idea what the risk measures of an asset allocation they recommend actually are, but they can recommend it and take action because using the words asset allocation creates a shared vocabulary that most investors understand. And by doing so, it bypasses a more detailed and what I believe to be a more appropriate conversation about how retirement portfolios should be constructed. So this has been a really beefy video, kind of high level and complex, and I think this is a good way or a good place to start winding down. So if you want to learn more about how we help our clients understand and navigate their retirement portfolios, you can visit our website at www.thepeakfp.com. Thanks for watching, and thanks as always for your time and attention. See you in the next video.